All right, so let's talk about mortgage insurance. So when you buy a house, you're going to have a few things integrated in the payment. You're going to have your principal and interest. That's what you have to pay based on the interest rate that you get in the loan amount that we're giving you as a lender. You're going to have your taxes, which is determined by county typically. And then if you have anything less than 20% down payment, you're typically going to be paying mortgage insurance. So I want to go through the 3 common types of mortgage insurance that you'll find when going out and getting yourself a mortgage. And I'm going to tell you how to avoid those in this video. So the first type of mortgage insurance is going to be your PMI, private mortgage insurance. And if you know anything about insurance, it's typically a protection for somebody or an entity. In this case, private mortgage insurance is protecting the lender in case the borrower, which would be you, defaults on the loan. So private mortgage insurance is typically going to be around 0.5 to 1% of the total loan amount. And that equates really to about $83 to $166 per month. Obviously, depending on the loan amount that you get, it's going to change. So that's what you can expect on top of your principal and interest and the taxes that you pay within your payment. Once you actually have 20% of your loan paid down, then that private mortgage insurance can actually drop off. Okay, so next up we have lender paid mortgage insurance. So this is where the lender is going to pay your mortgage insurance up front in exchange for a higher rate on your monthly mortgage payment. So the higher rates can be anywhere from 0.25% up to 0.5%. And the difference between regular PMI and LPMI, or lender paid mortgage insurance, is that LPMI never drops off. So it stays on for the life of the loan, which in an amortization schedule, you're going to see that the mortgage insurance that never drops off can equate to thousands of more dollars over the life of the loan that you're paying out of pocket, as opposed to having it drop off once you reach that 20% loan to value. Or you have 80% loan to value, 20% of your loan has been paid off. So that's lender paid mortgage insurance in a nutshell. The next type of mortgage insurance that you can expect in the type of mortgages that you're maybe inquiring about is going to be your FHA type mortgage insurance, or the mortgage insurance premium, it's called MIP. So because FHA has a little bit less stringent guidelines when it comes to approving you for a loan, they're going to give you basically more leniency for a higher cost. So on MIP, you're actually going to be paying mortgage insurance for the life of the loan unless you pay up to 10% more down payment up front. Then your mortgage insurance can drop off after 11 years. Also, the upfront mortgage insurance premium that you pay just starting out is an added cost to you as the borrower. So you're paying 1.75% on the entire loan amount in that upfront mortgage insurance premium, no matter what, when you go with MIP or the mortgage insurance premium. On top of that, you're having to pay an annual mortgage insurance payment of 0.45% all the way up to 1.05%. On average, it's about 0.85%. So if you're going with an FHA loan, just know that you're going to be paying more upfront for that mortgage insurance premium, and your actual mortgage insurance payment is going to be higher throughout the life of the loan, and it never drops off. So I would recommend, if you're going for a mortgage, try to go for a conventional loan, because it just gives you more bang for your buck throughout the life of your loan. So some ways to avoid mortgage insurance. Number one is having 20% down and going conventional, going with a conventional loan. The other ways is you can go with a USDA loan. Those are for homes in rural areas, and they don't necessarily match most borrowers' needs, because most borrowers aren't living in rural areas. However, if you do go with an USDA loan, you're going to pay a 1% fee upfront plus a 0.35% annual fee, similar to that FHA insurance premium throughout the life of the loan. The other option that you can do is go VA. A VA loan you're going to be paying 1% fee up front, and then also a funding fee, which can be anywhere from 1 to 3.6% of the loan amount. And it all depends on the type of situation that you have as a veteran. So not everyone's going to get the 3.6% or that 1% funding fee. They could have somewhere in between, depending on their situation. So those are the three main types of mortgage insurance that you need to be aware of when you're going into a mortgage, when you're looking to buy a house. Your knowledgeable loan officer and or bank loan officer that is working with you is going to share the different options that you have. And typically, if you go with a conventional loan, it's pretty standard to go with the mortgage insurance that they're offering you. Typically, when you go with lender-paid mortgage insurance, or you need to pay like a lump sum up front, maybe pay half of the mortgage insurance premium for the year up front, that's typically to get your down or DTI down, because with any mortgage you're going to have to be qualified, and if your debt to income ratio is too high, there are ways that you can pay your mortgage insurance up front to get your debt to income ratio down so that you have a qualified loan. So hope that was helpful, guys. If you do have any questions, leave them down in the comments. I'd be happy to answer them for you, and I'll see you on the next one. Take care.